Hi, and welcome to FTI Experts Hub, CP's quarterly podcast series with FTI Consulting specialists. I'm Laura Valean, Executive Editor with CPE, and as usual, I'll be your host. Today, we'll be talking about the push to bring manufacturing back onshore and how companies can access the capital needed to make these large-scale developments possible. Joining me is McRae Thompson, Senior Managing Director and co-leader of U.S. Tax Advisory in the Real Estate Solutions practice at FTI Consulting. McRae brings deep expertise in tax incentives, economic development financing, and real estate advisory, and he'll help us unpack where capital is available for onshore manufacturing projects today. Hi, McRae. Thank you so much for accepting my invitation.
Thank you for inviting me.
So to start, how would you define the current push toward onshore manufacturing in the US? Why is it being described by some as the new industrial revolution?
Yeah, so of course, like the onshoring push reflects an effort to locate more production capacity in the US. I think the new industrial revolution label reflects modern times and the fact that we're more focused on things like advanced manufacturing, sectors that are critical to national defense and supply chains, obviously AI, steel and the processing of rare earths, just to name a few.
Mm-hmm. Are there any specific types of manufacturing or industrial projects that are seeing the most momentum right now from both US and foreign investors?
Yeah, I think firstly, I'd say most people are focused on super large projects, so like the mega projects. A lot of the areas where we see the interest right now is semiconductors, advanced battery manufacturing, anything that enables AI. A few other areas that have been hot has been EV production, biotech, and then critical mineral and steel processing are definitely important.
Are all of these spreading all across the country or just in specific areas?
Yeah, I would say where we see activity and new facilities being built in the U.S. is really driven by things like reliable access to power, specialized labor, and yes, targeted incentives. I would say the large-scale federal subsidiaries, so things that historically were tied to semiconductors and clean energy, are expiring and being rolled back under the current administration. So really what we're seeing is the localities are playing a really strong role in influencing, where facilities are being developed. And a lot of that, it's beyond the incentives, but it deals with, they have the power to affect land entitlements, yes, tax incentives, but they can create job programs. And then they, probably most importantly, they can influence their own regulation, which is really important.
Right, right. At the same time, many developers expect significant federal support for onshoring projects. Are they often surprised by how limited federal incentives can be?
Yes, I very recently seen a number of developers that were very surprised by, not only how limited the incentives could be, they're very difficult to identify, they're very complex to obtain, and they can be highly conditional on, things that the government wants you to do. So while we have seen current policies, fuel a wave of onshoring, I would say direct federal financial support often falls short of expectations. And kind of the realities that developers face when they're trying to navigate this is, stringent but-for clauses, right? Would you develop this, facility without or but for the incentive? Cumbersome compliance burdens, getting tax credits instead of upfront cash, and then you'll see strict rules around using domestic content is another one. So.
Mm-hmm. So where are companies finding the most meaningful incentives today? Is it mostly state and local programs?
Yeah, that's exactly right. So the largest incentives are at the state and local level. While there's still federal incentives like R&D tax credits, clean energy grants, and those can provide a helpful baseline incentive package. Really what we see is the state and local governments are offering the massive, what they'll call deal closing packages. And those are the ones that really fundamentally alter the return on investment. So that's ultimately what drives a company's decision about where to invest.
Mm-hmm. What would you say are the most common state and local tax incentives available for industrial development projects?
Yeah, for state and local tax incentives, it's property tax abatements. That could be real and personal property, sales and use tax exemptions, which again is really more on the purchases of tangible property, job creation tax credits, and then one other interesting one is just alternative forms of financing, and that's where you get into industrial revenue bonds and tax increment financing to help fund projects. And really, what you find at the state and local level is there's kind of a combination of statutory and discretionary tools that they have that they can use. And, they can be very creative in terms of inducing development.
How do all these incentives, property tax abatements, sales tax exceptions, income tax relief, payroll tax incentives, all of these, how do all these typically work?
Yes, so all of these incentives are just economic tools that a government has to encourage, a business to invest capital, relocate headquarters, create jobs by reducing tax burdens. Essentially the government's foregoing its own revenue in exchange for long-term economic growth and community development. I think where it gets really tricky to answer the question is that each jurisdiction has a different program and procedures. They all have different state legal and constitutional requirements, and that really dictates how their incentive process works. So while there's a lot of opportunity, I would also say, each jurisdiction is very unique in terms of how they offer the incentive and how you approach it.
What would you say are the limitations of traditional tax incentives, especially for projects that need substantial capital upfront?
Yeah, so traditional incentives are fundamentally just ill-suited for capital-intensive projects, and that is because they are typically realized over an extended period of time, and that could be 20 to 30 years in some cases. So even if you get that incentive, a developer may still be forced to bear a steep upfront entry cost. And then on top of that, they're having to navigate, the risks of policy and law change, regulatory delays, stringent program audits, and all of that before they ever see an ROI.
You mentioned earlier industrial revenue bonds, so maybe some listeners are not that familiar with them. Could you explain what exactly industrial revenue bonds are?
Sure. So industrial revenue bonds can also be referred to as industrial development bonds. They're kind of similar to a municipal bond, so they're issued by a government agency on behalf of a private company. And basically, the way it works is the government, acts as a conduit. So it essentially allows a company to borrow money for manufacturing or public benefit type projects at preferential terms. In some cases, like the interest on those bonds could be exempt to the bondholder, which could be very attractive to the public markets.
How do they differ from grants, tax credits, or other economic development incentives?
Yeah, so industrial revenue bonds are a specialized financing tool, again, used to lower borrowing costs for commercial and manufacturing projects. I would point out that unlike a cash grant or a tax reduction, an IRB is true debt, so it does have to be repaid. But they are negotiated directly with local governments, which when you do that, the local government has the ability to combine them with discretionary incentives. So that just allows, certain jurisdictions to essentially circumvent, legal restrictions or constitutional restrictions for their government to offer tax abatements and incentives, through this conduit structure.
And why can IRBs be an attractive financing tool for manufacturing, industrial, and commercial developments?
Yeah, I think first off, as I kind of pointed out, I would say that you get potentially access to municipal interest rates, so a lower interest rate that might be offered, to a government, which lowers your borrowing cost. But probably the more important thing is, everybody we talk to is looking for kind of upfront cash or somebody to fund the equity. So really, what we see in certain instances, you could get up to 100% project financing using an industrial revenue bond. And again, inside of that negotiation, you're packaging that with large tax incentives. So really there, you're kind of getting the upfront, boost that you need in addition to the long-term substantial, savings over the life of the project.
And what types of projects are generally eligible to be financed through IRBs?
Yeah, so you see manufacturing and assembly, so facilities involved in the production, processing, or assembly of tangible goods. We'll see warehousing and distribution, so projects integral to industrial and manufacturing supply chains. You'll see them apply to corporate headquarters, relocation, and R&D facilities. Public infrastructure projects is definitely an area where you'll see a lot of this. So that could be water and sewer treatment, pollution control, solid waste disposal, different public utilities around energy. Others you could see kind of nonprofit institutional type services. So then you have 501c3 facilities like hospitals, medical centers, and higher education facilities.
Is there anything in particular that developers or investors should evaluate before deciding whether an IRB structure makes sense for their project?
Yeah, like I said, every jurisdiction's a little different, so it's kind of hard to know every single time. So I think what developers and investors need to focus on is, the impact of the financing mechanism on, their broader financial, position, including, what other debt and covenants do they have out there, any legal considerations, around flow of funds or different things, title to property, who's going to hold it. And then just, operations, will it fit with respect to the operations of the project? IRBs involve complex public-private type partnerships. So there are a lot of moving pieces that you have to kind of address in order to capture the benefit. But I don't know, what we see is, generally speaking, it can be worth it, especially for the large multi-billion-dollar projects. There could be some really, really large opportunities out there.
Mm-hmm. Are there particular states, municipalities, or types of local economic development authorities that tend to be more active or sophisticated in using IRBs? What are your clients telling you?
Yeah, I can give a few examples, and I would just note that, again, every jurisdiction is different. So whether you might be dealing with a state, a county, or a municipal entity, but generally speaking, I could just name a few that we've dealt with recently. So in Texas, the office of the Texas governor is pretty aggressive in terms of marketing industrial revenue bonds. In Virginia, you see more of the regional authorities are kind of the players you want to deal with. So, like one example, there would be Fairfax County Economic Development Authority. They leverage IRBs. And then, one state that's been using these for a very long time at the county and municipal level is New Mexico. So New Mexico Economic Development Department is definitely known for maybe even pioneering kind of the large scale tax exemption packages through the IRB structure. So there's a lot out there, and it kind of varies everywhere you go. But typically there's an economic development authority, and you can kind of start there and navigate through the different jurisdictions to figure out who you're going to be dealing with. And it might be the state, the county, the municipal, and the economic development authority. So again, it just kind of changes every time.
Right. Looking ahead, do you expect IRBs and state level incentives to become even more important as companies pursue larger onshore manufacturing projects across the US?
Yeah, I do. I think IRBs and state level incentives have always been critical. And again, I think people just see the headlines and they're focused on chasing after federal incentives. But that could just be really difficult, to do and to find. And especially if you pay attention to the U.S. political landscape, there's obviously a lot of change, and it's rapidly moving in different directions.
Right.
But the other thing to point out is, like past sources of federal funding, so the CHIPS Act, Inflation Reduction Act, they're all phasing out. So, I think more and more companies are just going to have to, focus on the fact that, they really should go after the customized and localized financial solutions to fund large scale projects. And IRBs are very flexible because it is negotiated. And probably more importantly, they create certainty over long periods of time. In effect, you're entering into a legal agreement with a government body. So, even if the law changes in the future, in theory, you should be protected, because you have an agreement with those entities. And I think that could be really valuable right now, just because there's so much disruption and change. It's a good tool to get certainty.
Right. Thank you so much, McRae, for sharing your thoughts with your listeners.
You're welcome. Thank you for inviting me.
Thank you all for listening. If you enjoyed this episode, please take a moment to rate and review the show on your favorite podcast platform. And be sure to visit cpexecutive.com for the latest commercial real estate news, trend stories, and insights from industry leaders. And while you're there, check out our new newsletter, Sneak Peek. Subscribers get early access to exclusive insights, data-backed analysis, and expert commentary on the deals, trends, and market shifts shaping commercial real estate today. You'll find more details and the subscription link at cpexecutive.com. Till next time.